Hey everyone, welcome back to SecureDApp's YouTube channel. So, as always, this is your host and host Kunal, and today we are back with episode 5 of SecureDApp Spotlight. So, what is SecureDApp Spotlight? It's a series where we sit down with industry experts to discuss the blockchain and cybersecurity regulations. Real talks, real insights, straight from the front lines of Web3 and digital security. So let me introduce myself. I am Kunal Chowdhury, content and community executive and a subject matter expert at SecureDApp. With me, we have Nikhil Prasad. Nikhil Prasad is one of the promising legal minds shaping the future of blockchain. At SecureDApp, Nikhil works as a blockchain regulation and a subject matter expert, playing a critical role in aligning the decentralized technologies with evolving legal frameworks. So, without wasting any further time, let me just hand over this mic to Mr. Nikhil Prasad. He will just give us a short intro about himself and tell us what we are heading to. So, over to you, my friend Nikhil.
So, thank you very much, Kunal. So, everybody, my name is Nikhil Prasad Singh, and I am a lawyer and very passionate on crypto and blockchain technology and its regulation. So, today we are going to cover all the aspects that are related to the crypto market pertaining to the United States of America. So we'll go through all the deep insights, all the taxation regimes, all the notifications, classifications, and everything that uh, my dear friend Kunal has came up with, every question that Kunal has came up with. So today we are going to cover United States.
Thank you, Nikhil. Thank you so much for your intro and the topic introduction that we are going to. Nikhil, first question that comes to my mind when hear about United States of America is what are the implications of FinCEN classification of crypto businesses as MSBs for startup entering the market or business?
Okay, so FinCEN is the most, as per FinCEN, most crypto exchanges, wallet providers, and certain token projects fall under the money services business category. And when transmit or convert crypto that substitutes for a fiat currency, this triggers several obligations. Okay, so first of all, there is a FinCEN registration that you will have to do within 180 days. And second, there will be a implementing a written implementation of a written anti-money laundering program. Okay, there will be filing of suspicious activity reports, SARs, and currency transaction reports, CTRs, and all that. And then there will be rigorous record keeping. For a startup, this means like budgeting early for the compliances teams and ML technology, and to build a robust framework from day one. Non-compliance risks include criminal charges, fines, and enforcement actions as well. And many new firms embed compliance tools like SecureDApp, ML suits, which automates SAR generation and wallet tagging, minimizing onboarding frictions as well. So these are all the classification implications that goes on with startups that are entering into this crypto market or crypto business. Okay.
Okay, my. Nikhil, you mentioned SAR. So SAR stands for suspicious activities reports, right?
Yeah, yeah, yeah.
Okay. And let us move on to our next question. So, how do state level regulations such as New York's BIT license that we hear about impact on VDAs, which we call virtual digital assets, companies operating across different states of US jurisdiction?
Okay, that's a very mm, deep question. Uh, I'll answer it in something different way. That is, New York's BIT license. That is, it's been active since 2015. So it requires a strong KYC compliance, AML compliance, and it's a capital uh, intensive compliance. It will be there will be cybersecurity policies for any entity dealing with the virtual currencies, and in the state, in that particular state. Furthermore, in key impacts for multi-state firms are mm, there will be inconsistent obligations across states. Example, crypto specific regimes in New York Texas and Minnesota. And furthermore, there will be duplications. That is, firm must comply with BIT license and SB rules, plus like licensure like New York Department of Financial Services approval, and there will be increased operational cost and fragmentations when onboarding users or opening bank accounts. And to mitigate this, many VDA platforms use centralized compliance modules that adapt KYC email policies and to policies to local rules. Solution One solution that can be of this is that there are jurisdictional compliance engine that will help standardize the process while dynamically toggling the requirements. Okay, so that's all.
Got your point, Nikhil. After hearing your answer, I just got one more question in my mind that how should VDA businesses navigate US privacy requirement in the absence of uh, federal data protection law?
Okay. So there is not something that is there is no data protection law. There are many data protection laws in the United States of America. There are their constitutional rights and all that. There is what Patriot Act. There are mm, many acts as well. So it is not something that there is no data privacy act. But when you talk about a specific to the VDA, you can state that there is no data privacy. But when you go deep down to the compliances, there are in data privacy acts as well. Like Patriot Act applies to VDA as well. Okay, so VDA business must comply with a patchwork of state work laws, such as there is California CCPA, there is Virginia CDPS laws, there are Colorado's CPA laws, each with a unique definition of personal data. So that is how every state has a different type of law. Every state has a different type of bill. So data subject rights and breach notification timelines, all those things are mentioned in that. Okay, action steps for VDA businesses as well. You can take many steps. There are map sensitive personal data. They identified where IP addresses, wallet addresses, KYC documents are stored and treated under each law. Okay, so there are implementation of layered privacy notices use dynamic disclosure tailored to each state's requirements, consent and opt out for state like California that require consumer rights to opt out of sale or data, and furthermore there are unified data governance, created centralized consent logs, breach response protocols, and privacy by design architecture and all. So there are enterprises often adopt compliances toolkits like you have SecureDApp Privacy Shield. Okay, so to generate state-tailored notices, centralized opt-outs, and all that. So I think Privacy Shield is something that is very important. Don't you think, Kunal?
Yes, Nikhil. One more question that comes to my mind is what are the compliance requirements under the travel rule that we hear about, and how do it affect the cross-border crypto transactions?
Hmm. Okay, so under the travel rule incorporated into the consent regulation under 2018. So VDA providers must transmit originator and beneficiary information for those transactions which are above the $3,000, and both domestically and as well as internationally to the other virtual asset service provider. So that is how the travel rule has been applying on it. And furthermore, when we collect any and verify sender receiver details, we have to verify that as well. Share this data securely with receiving institutions. So these challenges include fragmentary technological standard, example BSPs to ASPs messaging channels on high on-chain transparency, privacy tension. Many startups automate travel rule compliance with chain analysis tools as well. SecureDApp compliance engine can strike wallet metadata in real time and package it into compliant travel rule messages as well. So that is how.
Got your point, Nikhil. Got your point. So the next question that I have is how does IRS treatment of digital assets as property influence the tax reporting obligations?
Mhm. Can you please repeat the question again? I couldn't.
Okay, so I just want to ask how does the IRS treatment of digital assets as property influence tax reporting obligations in US?
So everybody has the same question. What is the tax? What is the tax on the virtual assets as well? Okay, so IRS is something that even the nobody wants to get on their back, on their bad side. Okay, so IRS treat digital assets as property and not a currency. So cryptos or NFTs will be considered as a uh, asset, not a currency. And a classification that triggers capital gains losses upon every disposal, sales, trade, or spend. This leads to from what I can state 1040 requiring there will be requiring a yes no at the top about the digital asset activity. There will be reporting sakes of capital gains losses and business receipts income from mining stating schedules. These are all mentioned in schedule C of the uh, schedule C of the reporting mechanism. The reporting mechanism further for brokers, hosted wallet providers, beginning 2025 information reporting using form 1099 DA gross proceeds in 2025, basics gains loss in 2026. These are all have to be mentioned. So these are all something that comes under the virtual digital asset regime as well. And thus individual and businesses that must maintain detailed transactional records, track cost basis, holding periods, categorize income correctly, and software assisted bookkeeping, bookkeeping as well.
Okay, Nikhil. So, one more question that I have pointed out in the US part of virtual digital assets. So, what is the legal consideration? What are the legal consideration? In fact, should a VDA companies address when offering stable coins and stable coin services? And it will be better if you just give an info about stable coin, what stable coins are.
So first of all, what stablecoin is? Stablecoin is something that is backed by a fiat currency or a stable currency, suppose or by a reserve, some reserves. So almost all the crypto assets or the tokens are backed by something. That is how they create value. Okay, that is why their people invest in it. So some cryptos like Ethereum, on their on-chain protocols and all are backed by their programming languages, and uh, all these are backed by some technologies, white papers. So cryptos, which are cryptocurrencies or tokens, which are backed by fiat currencies or stable currencies, these are called stable coins. And when we come to legal consideration of media companies, these are offering stable coins. In USA, even though stable coins are officially regulated as a money under US federal type companies because they are considered as a securities. Okay, because those are backed by fiat currency, they comes under the definition of the securities. So they will have to collateralize. Issuer should lock reserves in a high quality assets and undergo a regular audited collateral mechanism attestation. There will be a regulatory scrutiny. Providers may fail under MSB rules if stable coins are redeemable. There has to be securities classification risk as well. If redemption is not at par or is in short term, it may raise concerns from SEC and CFTC. It's essential and assess structure carefully. Providers should engage legal counsel early. Okay, so that much how uh, they are willing to go. And when we look at what state licensing, there are like states like New York require stablecoin to be specifically green listed or approved under bit license. And I mean, best practices would include engage legal counsel early. First of all, if you want to issue a stablecoin, you'll have to ensure a legal counsel. You'll have to publish a full reserve attestations We'll have to implement transparent redemption mechanics, and you'll have to uh, release everything. You'll have to tell them what technology you are backed with. You'll have to tell them what uh, reserves you have. You'll have to tell them what is the future, it's redeemable or not. That's all.
Okay. Nikhil, you just mentioned one thing, SEC. So how do SEC enforcement action inform best practices for token offerings and ICOs?
ICOs. So first of all, let me tell you what ICO is. ICO is something initial coin offering. So
Yes.
in the way where there are IPOs, that is initial public offering, in the same way we have ICO, that is the initial coin offerings. Okay, so recent enforcement, SEC's enforcement, like cases against Terraform Labs, there are KIK Labs, there is BlockFi, has emphasized like security analysis under Harvey. Tokens with profit sharing on investment intent are likely securities. There are promises or returns like passive or staking often trigger SEC scrutiny. SEC's scrutiny. Okay, marketing promises of returns, unauthorized bearing accounts, and in the best practices, there are will have to bear accounts. So this all underscore that tokens demonstrate characteristic of investment contracts. Okay, if you go into how we rule, it is treated as securities. Enforcement hinges on whether tokens offer profit sharing, staking rewards, or revenue sharing. Like marketing that includes return promises heightens enforcement risk as well. So if you want to go into what should we do, you should have a pre-legal review on the Harvey test. Harvey test is something that is determined for whether something is a security or not in the US. That test is also determined in various other countries as well. That is exclude further, you have to exclude a financial incentives like interest, dividends, unless a safe harbor is secured. Further, you have to maintain a clear, transparent tokenomics and reserve public disclosures and audited white papers. So you'll have to be clear on these parts, and only then you can go for ICO or what are the best practices in this.
Got your point, Nikhil. Got your point. So, talking about digital assets, Secured App works as a frontline defense for your digital assets and blockchain
Yeah,
security. And we have products like Secure Watch, Secure Shield, which just no need to code, no need to know any kind of code. It's a no code platform. You just need to sign up there, and you will your computer and or your phone just get secured by secured apps, secure watch or secure shield. They will detect 150 types of vulnerabilities and auto defend them. To know more, just go to securedapp.io and check out. So coming back to the podcast, Nikhil, so what role do self-regulatory organization SROs plays in shaping the digital assets compliance landscape?
see, although the US lacks designated federal crypto regulatory organization, crypto regulatory organization. Uh, there are like crypto UK or token alliances in the US that have performed a valuable role in this. They have developed best practices framework for the corporate governance, disclosures, and risk. They have coordinated engagement with regulators to influence constructive regulations. They have provided certification programs for professionals and firms to promote consistent standard. Some firms use and what I can say, like they have, in the absence of federal crypto SRO, many bodies have played this kind of roles. Okay, some firms embedded SRO frameworks like token alliances. They have posture proactively showing regulators and industry-minded approach. Okay, they coordinate industry consensus and legislative engagement to seek tailored regulations. They have published codes covering governance, tech, cyber risk, conflict of interest controls, and disclosures. They offer training and certifications as well. So that is how they are functioning right now, even though there is no SRO in the United States right now.
Okay, got your point, Nikhil. So, how are DeFi platforms regulated in the current US framework?
Okay, DeFi platforms and their US framework. So DeFi remains largely unregulated but implicated under existence rules. So there is no regulation per se related to the DeFi, but they are still in the legal battles. There are many cases. There are recent cases where DeFi has been included in included as a proper business organization. There are cases when instances when the main, even though there is a DeFi, it's a DeFi DAO organization, but but people have been arrested and charged. So these are all something that is still functioning. That if protocols retains control over user funds such as a lending pool or staking services, it may be deemed as an MSP or even a dealer under commodity or securities law. The SEC have initiated enforcement actions against certain protocols, arguing some token function as securities and involve unregistered platform operated activities. FinCEN has signaled that on ramps or custodial DeFi frontends need to register as MSB if they hold value. In practice, DeFi projects may partner with licensed entities or implement compliances at interface points. For instance, using SecureDApp compliance API within wallet interfaces can flag suspicious wallet require KYC before engaging smart contract on-chain. So I think SecureDApp is something doing very good work in this field, DeFi field. So
Thank you, Nikhil. I hope you are also integrated with SecureDApp.
yeah, yeah.
Okay, so that was really informative from yours and Nikhil. So, what can VDA companies do to comply with both federal and state AML and CFT regulations?
Okay, we'll see how they comply with AML safety regulation. So to satisfy the both the federal rule and the state rule, the first register as an MSB, and you will become under FinCEN compliant AML program, SAR, CTR, KYC risk assessment, and all that. Second, obtain necessary state level money transmitter licenses, often requiring bonds and state specific KYC policies. And third, and the most important, actively monitor or suspicious activity. Ensure travel rule compliances and update the specific changes as well. Okay, so when you uh, go into this MLCFT rule, you'll be required bit licenses, CN signed rules, each usually requiring bonding capital and state level KYC policies. So you will go through all of these things. Okay, so you will have to very careful when you implement these type of rules. Okay, to comply, ensure that you'll have to ensure compliances. So.
Okay, Nikhil, I understood. So, Nikhil, let's move on to the final question that I have in my mind. So, how does US regulatory approach to VDS compare with international frameworks like European Union's MiCA or Hong Kong or India? So, how does US regulatory approach is there?
Mhm. So US is, I think, still somewhere behind MICA because it has started developing laws, rules, notifications just after the Trump administration has come into power. So, I mean, it has active from only last 6 months, as far as I remember. If we comparing the US model is fragmented with overlapping agencies, state level regimes. There is no unified federal virtual asset provider license under a single law. There are, and when we talk about EU MICA, we have by far contrast offer a centralized pan EU licensing. So if you get license for one EU country, you will get for every other country. You will not have to go for each and every country. There is a pan licensing approach with uniform token white paper, passporting rights, and consolidated supervision. US model offers more flexible, more rapid innovation, but demands complex compliances across multiple legal regimes. So EU has a single regime. United States has a multiple regulatory regimes, just like India. So there is no difference. There is no particular difference between these two.
Okay, so it was really shocking because US being one of the superpowers in the world and one of the most developed economies, US is behind EU's MICA.
Yeah, I know. No, US is behind because it is not behind, but what I can say,
We can say
they
that they have started too late.
they have started too late. And if we compare it to India, it is by far very far ahead. So I mean, it has they even though there were no regulations per se, but there were notifications. So things were already in functions before that. There were more innovation, there were more compliances. It was just that the banks were not permitted to transact in this particular domain, function in this particular domain, approve this type of transactions. But after the US Trump administration has came into power, we can see that many notifications that came in 2019, 2020, that were stopping businesses, stopping banks to operate in this particular domain, have been permitted now. So even though it is still come under the securities definition, but there are many more innovation-led laws that have come up right now within the past 3 4 months. We can see there is crypto roundtable meeting happening every matlab 2 times every month from the last 3 months. So almost they have almost completed, I think, 5 crypto roundtable meetings. So under that, they are trying to develop more crypto centric laws. Even though they have started too late, but I don't think they will not be able to catch up with you, because United States is such a big market. United States has so much investment, innovation, such a legal, so much beautiful mind. So I think they will be able to cope up with the EU in no time. So EU
Definitely,
always
Nikhil.
has very good laws.
I agree on it. So, Nikhil, we are done with the questions. So, any final words from you for our audience and viewers?
Hmm. And what I can say is that US is a good place to start. I think they have started. mm, they have started permitting banks as well in this to operate in this particular domain. So you will see a lot more investment in this particular domain. So you can start any business in the US right now. But let's hope very good for India.
Hope so, hope so. So, Nikhil, thank you so much for being such a gem of a guest here and such a gem of a speaker, rather. Very informative session. Uh, you have touched real insights. Even I was not knowing many of the things that you told me, that you mentioned here. So thank you very much, bro. So thank you, audience. This was the episode 5 of SecureDApp Spotlight. If you like this video, please hit the like button. Share this video with your friends, families, and colleagues. Subscribe to our YouTube channel, SecureDApp. We will definitely see you next time on the sixth episode of SecureDApp Spotlight. Till then, stay safe, stay secure, and as always, I say, stay ahead. Thank you.